Just a heads up before I get into 15.2, Beckett is playing in the background. He's playing really good right now, so let's hope that he lets me get through this video with no interruptions. So 15.2, we're going to talk about adjusting merchandise inventory and interest receivable. So we have two learning objectives. You need to be able to adjust merchandise inventory, and you need to be able to adjust interest receivable. So first, we're going to talk about, we have some terms here. Beginning inventory is the amount of inventory at hand at the beginning of a fiscal period. So it's our inventory that we start with at the beginning of the year or whatever our fiscal period is. During that period, though, we're going to purchase more merchandise and we're also hopefully going to sell merchandise. So to determine how much merchandise remains in inventory at the end of the period, a physical inventory is conducted. So that's where we're going to physically count how much inventory we have. The actual count of merchandise at the end of a fiscal period then is called our ending inventory. Okay, so to recap that, we have our beginning inventory, the amount that we start out with. Then throughout the period, we buy and we sell. At the end of the period, we do a physical count, and that physical count then would be our ending inventory. So we're going to need to do an adjusting entry for our merchandise inventory to make sure that it shows the actual amount of inventory that we have. So here we see from our unadjusted trial balance, we see that our merchandise inventory is 108,486.44. But when we do our physical count of our merchandise inventory, we see that it should be 102,838. That tells us that we are going to need to decrease our merchandise inventory. So to decrease our merchandise inventory, we need to credit that account by $5,648.44. And then we're going to debit income summary. Income summary is the account that we're going to use to kind of, what I think of it is we're going to throw amounts in there and then we'll deal with those amounts later on. Okay, so we're debiting, when we look down here, we're debiting our income summary, we're crediting our merchandise inventory. Journalizing the adjusting entry for interest receivable. So they tell us accrued interest income. That is the interest that is earned, but we have not yet received that interest. So they show us two accounts here. Interest receivable, we debit to increase it, we credit to decrease it. Interest income is the opposite. We're going to debit to decrease, we're going to credit to increase. Here's our adjusting entry for our interest receivable. So again, I'm going to look at my unadjusted trial balance. When we look at that, notice our interest receivable, we have nothing in there, but there is interest. Okay, so I'm going to go back to the previous slide, sorry. There's interest that has been earned but not yet received. So meaning we have not actually physically gotten that money yet, but we've earned that money through interest. So that we have our debit to oh, they have that wrong. That should not be interest expense up there. That is wrong. So we have our debit to interest receivable. This is right down here. And then we have our credit to interest income. So we're going to increase that interest income. Audit your understanding question number 1. I do want you guys to kind of pause and see if you can answer these questions on your own. So question number 1 is, how is the amount of merchandise inventory on hand at the end of the fiscal year determined? So at the end of the fiscal year, how do we determine how much inventory we have on hand? This is where we're going to do a physical inventory. So a physical inventory is when we do a physical count. So those of you that have jobs that work in retail, you might have had to take part in this, where you go up to the shelves and you count every item. Number 2, what adjusting entry is recorded when the ending merchandise inventory is greater than the beginning value? So we did not see this when we were going through the PowerPoint. When we were going through the PowerPoint, our ending merchandise inventory was less than our beginning. Okay, so we're looking at the opposite. What happens if our merchandise inventory is greater than the beginning value? We're just going to flip that transaction then. So we would debit merchandise inventory to make that merchandise inventory larger, and we would credit our income summary. Question number 3, how often is revenue earned on an outstanding note receivable? So we are going to earn interest daily. Okay, so that's where they're talking about that revenue on the outstanding note receivable. Now, in the PowerPoint, it didn't really show us about those notes receivable and how we figured out that interest. But when we do that work together, that's going to be more obvious when we do that. So, question number 4, what types of accounts are increased by recording and adjusting entry for accrued revenue? The adjusting entry for accrued revenue is going to increase our revenue account with a credit, and it increases a receivable account with a debit. So this is the end of 15.2 lecture. You can now go on to the 15.2 work together video and complete the 15.2 work together.